Welcome to the second video for Chapter 2, where we're taking a look at managerial cost concept and cost behaviors. So the cost behavior is what we're going to focus on in this chapter. We're going to talk about how the different costs that we are exposed to in a manufacturing or even in a service-based setting, how these costs change with levels of activity. How they react to changes in activity help define whether they're variable or fixed. Okay, so we're going to start with variable costs. When we look at variable costs, these are costs that vary in total directly and proportionately with changes in activity levels. So the key here is that total variable costs change directly and proportionately. And what that means is as activity levels increase, and let's say, for example, we increase activity levels by 10%, what this means is that variable costs in total will also increase by 10%. If volumes were to decrease, then our total variable costs would decrease as well. Variable costs by nature are ones that we only incur if we produce a unit. So an example would be direct materials and direct labor. So we don't have to use the raw material if we don't make the product. We don't have to pay for the labor if it's not required to convert the raw material into a finished product. So the more units we produce, the more materials we're going to use and the more labor that we're going to use. Therefore, those costs move upwards and in the same direction as volume does. So total costs, when we're talking about variable costs, total costs increase at the same rate as activity. Okay. What's important to remember, though, is that the cost per unit for variable costs never changes. Within our relevant range, our variable cost per unit stays static. It's always going to cost us $5 in raw materials for each widget. The more widgets we make, the more variable costs we incur. But on a per unit basis, it's only ever going to cost us $5 per unit. So examples of some variable costs include direct materials and direct labor, like I've mentioned, sales commissions for a merchandiser, right? So if we pay 10% of all sales out as a commission, the more these people sell for us, the more commission we're going to have to pay out. So our commission expense increases directly and proportionately with the number of sales. If sales go up by 10%, our commissions cost is going to go up by 10%. So variable costs, again, they change directly and proportionately in total with changes in activity levels. So let's take a look at an example and see if we can make sense of that. So Damon Company, in this example, manufactures radios that contain a $10 clock. So the variable cost per unit is $10. That's going to stay static. Regardless of how many clocks I make, the per unit cost is always going to be $10. What does change, however, is the total variable costs. So for each extra radio that we manufacture, our variable costs in total are going to go up by $10. And we can see this in the example. If you look at the purple text at the bottom, if we sell 2,000 radios, or if we manufacture 2,000 radios, the total cost of all the clocks is that 2,000 radios times the $10 per clock, or a grand total of $20,000. So total variable costs are $20K, but the per unit cost is still only $10. If, however, we increase the number of radios that we make, and now instead of making 2,000, we're making 10,000 radios, the total variable cost is going to go up because now we have 10,000 radios that each require a $10 clock. So our variable cost in total jumps up to $100,000. Again, per unit though, it's still only $10 per unit for variable costs. Now, if you remember the last slide, it said that total variable costs increase directly and proportionately with changes in volume. Well, you can see that we went from 2,000 radios up to 10,000 radios in this example. So we went up 5 times, so 500%. So we increased the number of radios we made by 5 times. Well, look what happened to total variable costs. They were 20,000 and they jumped up to 100,000. They also went up 5 times. Okay? So total costs, total variable costs increase at the same rate as activity. But per unit, they never change. That's completely different than the next type of cost we're going to talk about, which is fixed costs. Total fixed costs, it's the opposite. Total fixed costs stay static. They stay fixed. That's why they're called fixed costs. So regardless of activity level, my fixed costs are set. So imagine a company that rents its production facility. So we're renting out our production facility, and we pay $5,000 a month for our production facility. That's what our rent is. Regardless of whether we make 1 unit or whether we make 1,000 units a month, that rent stays the same. We have a contract that says we're going to pay $5,000 a month. It's not based on how much we produce. So changes in activity have no impact on the total fixed costs. But what they do impact is the fixed cost per unit. If you were doing a calculation to say, this was my fixed cost per unit for the month, you would take your total fixed costs and you would just divide it by the number of units that you made. So fixed costs have an inverse relationship on a per unit basis. What that means is as volume increases, the per unit cost of fixed costs decrease, because you're getting to take that set fixed cost figure and break it out over more units. So we pay $5,000 per month for rent. Regardless of how much we make, that's what we pay. It's fixed. In total, it doesn't change. But let's say we make 1,000 units. Well, I take my $5,000 rent, I divide it by 1,000 units, and now my fixed cost per unit is $5. But what happens if we only make 500 units? Well, my fixed cost per unit is going to go up, right? I'm now taking my $5,000 total fixed cost, which again doesn't change with volume, but now I only get to break it out over 500 units. So my activity level decreased and my per unit fixed cost goes up, because now I'm taking $5,000 in total cost and breaking it out over 500 units, which is now $10 per month, or $10 per unit, I mean. So some examples of fixed costs include property taxes, insurance, rent, all these things that aren't tied to volume. They're set fees. We pay our insurance at the beginning of the year, most likely, and we break it out, we allocate it out month by month, but the cost doesn't change with volume. Neither does our rent, neither do our property taxes. Okay? So to try and give you a clearer example than the one I just muttered, let's take a look at something on the overhead here. So we'll take that same company we were talking about before, Damon Company, but let's pretend that they lease their productive facilities and they pay $10,000 a month to lease their facilities. So total fixed costs don't change. Whether they make 1 unit or whether they make 100,000 units, it's going to be $10,000 a month. But on a per unit basis, you can see that the cost of rent per unit gets cheaper as activity levels go up. That's why I say they have an inverse relationship. So at 2,000 radios, if we're making 2,000 radios, what I get to do is I get to take my $10,000 I'm paying per month and break it out over 2,000 radios. So 10,000 divided by 2,000 is a unit cost of $5. At 10,000 radios, however, so you can see that our volume has increased by 5 times. Our fixed cost in total doesn't change though. We're still paying $10K. But our per unit cost, what we get to do now is we get to take that $10,000 and we get to break it out over 10,000 radios. So the per unit cost drops to $1. Okay, so in total, fixed costs never change, but per unit, they move the opposite direction of volume. So as volume increases, per unit fixed cost decrease. As volume decreases, per unit fixed costs go up. Right? That's what this next slide talks about. So variable costs stay the same per unit at all times, but in total, they increase with volume. Fixed costs are the opposite. In total, they never change, but per unit, they change with volume changes. As volume goes up, per unit fixed cost goes down. As volume goes down, per unit fixed costs go up. So that's variable and fixed, right? One in total changes with volume and one does not. Now what's this concept of mixed? So that was on the first slide there. We said we were going to talk about variable, we were going to talk about fixed, and we're going to talk about mixed. Well, mixed is a combination of the two. So a mixed cost is something that has an element of fixed costs in it as well as a variable cost element. So it's something that has a combination of the two. So what you'll see with these costs is that they do change with changes in volume. So as volume increases, your mixed costs will increase as well, but they no longer change at the same rate, just like your variable costs do, because they have a fixed cost element. All right. A perfect example of what a mixed cost is your telephone bill. Maybe not your cell phone bill, but potentially. But think of something like your home phone, right? Your home phone probably has a basic charge that you pay every month. Let's pretend that it's $19.99 a month. So that's a fixed cost. Whether I make one phone call or I make 100 phone calls, as long as they're all local, my fixed cost, my telephone bill doesn't change. It's $20 a month. Okay. But what happens if I start making long distance calls? Right? Long distance calls are typically charged out at a rate per minute. So the more long distance calls I make, the more my long distance charges will be. That's variable. So you can see that a telephone bill has a combination of both. It's a mixed bill. It has a combination of fixed costs, which is that basic monthly charge, and an element of variable cost, which would be the long distance charges. Your cell phone would be kind of the same way. You probably have a flat rate that you pay to get a certain amount of daytime minutes and a certain number of texts. Most plans are unlimited text now. But the same thing, like I think I have 150 minutes on my cell phone. That's all built into the basic fixed cost of my phone, my $50 a month. Now if I use more minutes, I start to get charged for each minute that I use. That's variable. So my cell phone bill would be a mixed cost. It has a component of both fixed and variable. So that's cost behavior. That's how our costs interact. And the reason we need to understand this is because later on when we start to analyze financial information, we have to know how certain costs within a business are going to react with changes in volume, so we can decide or do some sensitivity analysis for profitability levels on whether or not we should even move forward with a new product. Are we going to be able to break even? Are we going to hit the income target that we had hoped? So this general understanding of behaviors is really important for the rest of the course. That's it for this one. The last video in the chapter is going to focus on the manufacturing process flow, which is just a discussion as to how costs flow through a manufacturing company. Okay, so hope you enjoyed it. I know it was I think it was a little bit longer than I wanted, but I think we got across all the info we needed, and I'll see you in the next video. Cheers.